Welcome to this week's special presentation titled, Can Your Portfolio Take a Punch? My name is Todd Shaffer, Manager of Research for VectorVest, and I'll be providing your presentation this evening. Everyone knows that stock prices don't go straight up. To be successful, we have to allow them some wiggle room. As Dr. DiLiddo commented, it's like a boxer who has a great right hand but can't take a punch. But if you can't take a punch, you're going to lose. So how about your portfolio? Can your stocks take a punch? Or are your stops so tight that you get KO'd in the early rounds? Or to stretch the analogy, are your stops so loose that you wait too long to get knocked out, watching winners become losers before throwing in the towel? As Dr. DiLiddo wrote in his book, Stock Strategies and Common Sense, selling is a crucial part of successful investing. The use of stop prices is one of the most controversial and misunderstood methods of selling stocks. Stop prices are double-edged swords that can cut losses and protect profits, or when misapplied, result in high turnover and lost opportunities. If you struggle with the decision of when to sell, it may be helpful to know that this is an area where a lot of people struggle. In fact, Dr. DiLiddo includes an entire chapter on the subject in his book, and we devote an entire session to the subject in our Successful Investor course, and it's a frequent topic of conversation on our weekly Successful Investor coaching sessions. While there are no hard and fast rules for selling stocks, every investor eventually makes a decision to sell. Sometimes reasoned, sometimes not. Whatever the reasons, if we're doing this right, the primary purposes of selling a stock should be to control losses and to protect profits. Stop prices are ideally suited to do both. But if you don't use them, you won't get either. They should be determined before the trade is entered as part of trade setup and to help avoid emotional, unreasoned selling, which will often get you knocked out. So where do we start? Our approach to selling stocks should correlate to our approach in buying stocks. Every investor has an intuitive sense of their own risk-reward profile. It dictates their investment patterns, and we get nervous when we operate outside our comfort zone. A key to becoming a successful investor is in recognizing your investment style, in buying stocks which are consistent with that style, and managing them in a manner consistent with the style. We identify 4 basic investment styles: aggressive, conservative, prudent, and speculative, and we arrange them in this strategic investment matrix. Risk is on the x-axis, low to high, and reward is on the y-axis, low to high. Each trading style represents a different combination of risk and reward. The investor that belongs in box number 1 prefers low risk but still wants above average returns. They'll look for fairly safe stocks that have a lot of upside potential. They are the prudent investor. The investor that belongs in box number 2 also wants high returns over time and is willing to take on a little more risk to get them. The stocks they choose can have more volatility, but that's what this trader counts on. This investor tries to take advantage of quick pops in a stock's price. This investor looks for stocks with a lot of upside potential and accepts higher risk. They are the aggressive investor. The investor that belongs in box number 3 favors safety, low risk, over upside potential. They look for companies that have been around a while, that are well managed and have predictable earnings. While these stocks may appreciate slowly over time, it's not the major consideration for this investor. This investor likes a storehouse of value and reliable dividends. They are the conservative investor. Finally, in box 4, the investor in box 4 doesn't care about the financials of a company and is willing to take a lot of risk over time. They're hoping for the occasional home run to cover their many losses. Their stocks typically have little upside potential and are more volatile. They choose unproven companies that may have a new product being released into the market, and they're hoping for a big payoff. They are the speculative investor. So, what's your investor type? And how can you use this information to find and manage your stocks? VectorVest has 2 proprietary indicators that reflect a stock's reward and risk profile. The indicator we have that looks at reward, upside potential, is relative value, or RV. Relative value looks at long-term capital appreciation potential compared to an alternative investment in AAA corporate bonds. Relative safety looks at the consistency and predictability of a company's financial performance, their debt to equity, sales volume, and business longevity, and their price volatility. Both of these indicators are cast on a 0 to 2 scale. A score above 1 is favorable, below 1 unfavorable. So VectorVest scores stocks with high upside potential with RV greater than 1. Stocks with lower upside potential with RV less than 1. Stocks with high risk will have RS less than 1, and stocks with low risk will have RS greater than 1. So let's match investors with their stocks. On this theoretical price graph, the prudent investor A prefers stocks that have good upside potential but low risk. A graph pattern similar to this. A nice 45-degree slope over time, nice predictable price swings with low volatility. The aggressive investor B prefers stocks that make quick up moves so they can capture faster gains. However, they know they are taking more risk of getting caught in a sharp reversal. They often try to mitigate the large swings by taking small parts of the move, and so they're more active traders, meaning they might use techniques that try to get them into the trade at the beginning of the uptrend and out shortly after the peak. And do that time after time, just taking the positive swings out of each of the market moves. Both the prudent and the aggressive investor like stocks with good upside potential. But if the prudent investor bought stock B, they would be a nervous wreck holding the stock through the wild swings, even though it was ultimately moving higher. Of course they wouldn't, because at some point their emotions will get a hold of them and they'll sell at max pain. Conversely, if the aggressive investor buys stock A, they'll be impatient to make gains and feel the need to quote-unquote do something to accelerate the process, like sell prematurely to chase something else more exciting. The conservative investor would much prefer a graph that looks something like this. Prices appreciating over time, but at a relatively slower rate, a shallower slope to the line. The key for them is not upside growth, but stability and safety. They're most concerned with capital preservation and the dividends that come with well-established companies. A common mistake for conservative investors is to suffer outsized capital losses in pursuit of a relatively small dividend yield. Speculative investors buy stocks that often look like this. Over time, they move down in price and can have wild price swings. They're typically trying to buy in low on small companies before the company makes its mark with a new product or service. They hope to harvest the outsized winners to cover their plentiful losers. So which type of investor are you, and which type of stock do you want to buy? Does it seem logical that the type of stock you buy would dictate how you manage them? It would be very hard to outperform the market day trading conservative stocks, and very hard to outperform the market trying to buy and hold aggressive or speculative stocks. It is critical that you understand your objectives and time frame for the stocks you're buying and trading tactics that you employ. So now that we've identified our investor temperament and our objectives in the trade, it's time to choose a stop that works with that approach. The modern marketplace offers an overwhelming array of choices, an array of techniques and indicators much too broad to cover here. You should be prepared to do some study of various tools. But for a general conversation on stops, it's most helpful to think of your choices as a continuum starting at one end with slower, less sensitive indicators that are farther from price action and give the price more wiggle room, and at the other end, fast sensitive indicators that track closely to price action a trader would use to jump in and out of trades quickly. For our demonstration, we'll use 4 indicators that roughly approximate different points along the continuum, starting with the conservative side, our sell recommendation, which is derived from a 13-week moving average of the stock's price action adjusted for its fundamentals. Stocks with strong fundamentals get more room to run. The RT crossover from above 1 to below 1, indicating the end of our trend. A simple 40-day moving average of price. And the price action itself at the most aggressive end of the spectrum. We'll begin by looking at each of these indicators on a price chart, but we do also support charted and portfolio manager automated indicators. And we'll discuss those after we've looked at a couple charted examples. But as we've often quoted Dr. DiLiddo, past is prologue. But when we're looking at a stock graph, what you see in the past is likely what we will see in the future. Applying the various stop criteria to stocks we wouldn't mind owning is a great way to develop an effective trading system. We can use historical stock performance in the context of our trade objectives to define quote-unquote normal price behavior. Proper stop-loss selection defends against abnormal price behavior and a knockout blow. Of course, it's easiest to see changes in price behavior if you start with stocks that have smooth and steady price patterns. Let's take a look at a recent example that's been in the news, Micron. From the VectorVest homepage, we'll click on the Graphs tab, and here we have a 1-year daily data point graph of Micron Technology, MU. On the graph, we have the price action of the stock on daily candlesticks, a 40-day moving average moving through that stock price, and on our subgraph, our relative timing indicator. Let's remove the 40-day moving average, and we'll add earnings per share on another subgraph. And from the perspective of the conservative investor, we have bottom left, upper right smooth price pattern driven by a bottom left, upper right price pattern in earnings per share. Just the kind of performance that a conservative investor would like to see. Let's take off the earnings per share, and if we looked at this price pattern, the conservative investor would say, well, gee whiz, I would like to hold this stock for the whole past year. I don't see any reason that I should have gotten in and out of that stock. It's doing just what I want it to do. So in fact, if we put on the VectorVest stop price, it did a pretty good job of keeping me in the stock. Came close and tagged here in August of 2017, but generally has given that stock room to run, room to wiggle, and kept me in it on pullbacks to capture future gains. What I might like to do is look at a longer time frame and see if it does a good job of getting me out on severe pullbacks. So let's click a 5-year window. And we can see in this pullback that MU experienced in 2015 through 16 that yes, indeed, the price action did fall below the stop price and would have gotten me out of the trade. Going back to our 1-year window, we see that while the price has been overall in an uptrend, it did suffer a couple periods where the price action was relatively flat. And we notice that the RT indicator on our subgraph below started hitting lower values during that flat price action, an indication that the stock was losing momentum. If we zoom into this time frame, we note that RT actually crossed below 1 on the 3rd of July, and although it recovered, it never got to a higher price before rolling over again and ultimately crossing below 1 again on the 28th of July. A good early warning that the trend had changed from an uptrend to a downtrend. If your trader temperament is a little more aggressive, you might be saying, hey, wait a minute, I don't want to ride out these flat periods, right, from June to July. I don't want to sit in that trade for a month while it does nothing. Do you have something a little more aggressive that would get me out of some of the bigger pullbacks but still capture the bigger moves? Well, let's clear our trade, and we'll take off the VectorVest stop price, and let's put on a 40-day moving average. And I'll also remove RT so we have a better view of the price action. We see the 40-day moving average follows price action much more closely, where price tested 1, 2, 3, 4, actually broke on the 5th time and has broken the 40-day moving average now. And so I'm starting to see some of the trade-offs where I have the price closing below the 40-day moving average. I would have closed out and been whipsawed right back in because I have a more sensitive indicator. But it did do a pretty good job of defending me against the bigger pullback. And of course, as we come to the current price action, while the sell recommendation still had us in the stock, the 40-day being closer to the price action has limited the amount that we give back. Of course, if you turn it up a notch, the short-term trader may say something like, well, no, Todd, I'm interested in getting only these upswings. I don't want to suffer hardly any pullback at all. So they want a faster signal. Well, what's faster than a 40-day moving average? How about a 10-day moving average? Right-click on price, hover on add moving average, simple, 10-day. That'll appear at the bottom of the list, and put a check mark on it. Let's take off the 40 so we don't get confused, and we see that that 10-day moving average is very close to the price action. And as requested, it's capturing the bulk of the up move. Well, what's the downside? Well, of course, because it's so close to price action, it'll have more whipsaw signals. And just the number of trades. 1, 2, 3, 4, 5, 6, 7, 8, maybe 9 trades. All in the course of time that our conservative investor made 1. Which is another reason why the more aggressive investor has to put such a premium on a fast price advance, because they have to cover those costs of a heavier trading regimen. And of course, at the fastest end of the spectrum would be to use price itself. As we zoom into the last 4 months here, we'll take off our moving average. We can use things like trend lines on price to help us identify when the trend has broken. Or we can use candlestick formations themselves, like this bearish engulfing. Or just the directional change in price, particularly when it comes with higher volatility. Big tall candlesticks. And of course, at the furthest extreme would be day traders looking for intraday moves on a single candle. And so the key here is to apply the techniques that are appropriate to your temperament to the kinds of stocks that you trade, and do some historical examination to develop your trading plan. With each of these approaches, we understand that we're going to have losing trades, and that's okay. The key to success is to have our winners outpace our losers. In the VectorVest Portfolio Manager, the system can track our stock's performance and send us alerts when any stop criteria have been met. The stop criteria can be found if I click the Edit button. I have the Portfolio Genius. And if I customize the trading system, here are the stop criteria available within the system. We begin with VectorVest indicators. Rec equals sell, Rec is not a buy, VST below a certain value, RT below a certain value. We also have a percentage gain loss. These are static values, and wider ranges typically suit those nice trending steady eddy stocks better, where the trader might use a tighter mix. Next, for some traders, a price-based stop with the prior day's closing price, a percentage below that price, or the prior day's VectorVest stop price. Our ratchet stop follows the VectorVest stop price upward but won't let it adjust downward. The trading stop looks for that big red candle we see on some price reversals, and a trailing stop. This stop will adjust itself upward following a fixed distance from the last established high since we bought the stock. Of course, we can supplement that with target gains and a maximum loss as well. And a word of caution, particularly on percentage stop losses, be careful of the kinds of stocks you trade. Many low-dollar stocks can have intraday volatilities of 5–10%, and a tight trailing stop on that kind of stock will knock you out in the first half hour. So remember, I always want to make sure that I'm allowing the stock to do what it normally does. And if it normally ranges 10%, I'm going to have a trailing stop greater than that, or only apply it on the close. Scrolling down, we have the prior day's low price, the trailing average true range stop. This stop calculates the average price range over the last 10 days, whatever period you select. And so it's self-adjusting. If the stock over the last 5 days had an average price move of $1, it would apply a trailing stop of $1 to the stock's price movement, and that would get recalculated every day. The multiplier lets you multiply that average range to maybe $2. And finally, our most recent addition to the offering is our Profit Locker stop. It does a fantastic job of balancing the wiggle room of an initial wide stop with locking in gains with a tighter stop as price advances. The best way to determine the right combination is to backtest them in the backtester or paper trade them in the live market to gain some experience. Like their charted cousins, you'll find broader stops work better with safer stocks and tighter stops work better with riskier stocks. Be careful not to set your stop so tight that it knocks you out during a normal move. Once you've decided your stop criteria, you'll have to decide to tell or not to tell. And that's your broker, of course. And I have two considerations. Are you using end-of-day stops or intraday stops? In other words, if the price action just tags your stop, do you want to be taken out of the trade, or do you want to make sure that the close is below the stop by waiting for the end of the day? In addition to that, do you want to just hold those stops mentally, in other words, on your own system, or do you actually want to place orders with the broker? If you place orders with the brokerage, then of course you'll be stopped out on a tagging basis. So let's recap some of the big pointers here. Number one, let your stock perform as it normally does. Limit abnormal behavior with your stops. We prefer to raise our stop as price rises, therefore locking in gains. But one of Dr. DiLiddo's cardinal rules is to not give back more than 50% of your gain once it gets into double digits. Next, we prefer to let our winners run because one stock that exceeds your expectations can make up for several losers or several mistakes. And finally, decide your stops before you enter the trade. The key to avoiding emotional trading begins by having a trading plan, and that plan should be determined before you enter the trade. In fact, the time to modify your plan is when you're safely in cash. This helps assure that your trading is an intellectual exercise, not an emotional one. This is a very broad but important topic, so I want to share some resources with you. Dr. DiLiddo has written extensively on this subject. I offer you some of the resources of his essays and our book, Stock Strategies and Common Sense, available in the Special Reports section of the VectorVest Views, and some strategy presentations. And while we understand that this will require some further study on your part, your efforts will be paid off handsomely as you win the fight for higher profits.